Welcome back to Talk Tickers. We are doing a deep dive today into, well, one of the most talked about names in that whole domestic critical mineral story, USA Rare Earth Inc., ticker USR.
That's right. USR. Absolutely central, to this whole mine to magnet idea that's getting so much attention.
Exactly. And their Q3 2025 earnings call, it was just on November 6th, after hours. Now, the numbers on the surface looked a bit rough.
They did.
But the market, it jumped almost 10% the next day. So we really need to figure out what's going on there, because clearly it's not about Q3 profits.
No, definitely not. It's all strategy, execution potential, and maybe most importantly, cash.
Right. So for these pre-revenue companies, especially in, a sector like critical minerals with all the geopolitics.
Precisely. An earnings miss, well, it often takes a backseat to strategic updates. Yeah. How much runway do they actually have? That's the key.
So the call wasn't really about Q3 results then?
Less about Q3, much more about confirming this accelerated vision for 2026, 2027. You have to look past that headline noise.
Yeah.
Understand the balance sheet. That's what lets them hit the accelerator.
Okay. Let's start right there then. The numbers. If you just looked at GAAP EPS, you might have had a heart attack. A loss of $1.64. That's huge compared to like a 33 last year.
That's a difference.
And even the adjusted non-GAAP loss, $2.25, still missed the street estimate of $2.10. And, well, zero revenue, obviously. Expected, but still zero.
As expected.
So that giant $1.64 loss, what was really behind it? Why did investors just seem to shrug it off?
Well, the devil's always in the details, isn't it? Usually in the 10Q footer. The headline net loss was, yes, a big $156.7 million.
Okay.
But, and this is the crucial part, $142.4 million of that.
Yeah.
It was a non-cash fair value adjustment.
Non-cash. Okay. Related to?
Warrants and earnout liabilities.
Right.
Standard stuff for companies at this stage, but it creates accounting volatility.
Right. So for listeners maybe less familiar, that fair value adjustment, it's basically just accounting noise, not real cash going out the door.
Exactly. It's accounting volatility. Warrants give people the right to buy shares later, right? As the stock price moves, the value of that right changes on paper. It makes the P&L look messy, but it isn't cash burn.
Okay, so what were the numbers that mattered then for keeping the lights on?
Good question. The loss from actual operations was $15.9 million. And the core adjusted operating expense, sort of the real underlying cash burn rate for the quarter, was only $8.9 million.
$8.9 million. That's a much clearer picture of what they're actually spending to move things forward.
Right, that's the number to watch for the burn rate. Yeah.
And that distinction, that's key. It leads us straight to, well, probably the main reason for that stock jump, the cash, their cash position.
Absolutely. They ended Q3 with $258 million in cash and basically no significant debt, which is already pretty strong.
Pretty strong. That sounds very strong for a pre-revenue company. But it got even better.
Oh, yeah. This is where it gets really interesting. After the quarter ended, they had warrant exercises, not redemptions, actual exercises. People buying shares.
Okay, so cash in.
Cash in. An additional $123 million straight into the Treasury. That pushed their total cash position as of early November to over $400 million.
Wow. Over $400 million.
Yeah. For a company like this, facing all the execution risks, having a $400 million buffer, it's a monumental de-risking event. Investors love to see that.
Okay, so that much cash, it basically solves the funding worry for, the next couple of years at least?
Easily. It gives them significant runway.
But cash is only one piece, right? It doesn't guarantee they can actually build the things or sell the magnets. The new CEO, Barbara Humpton, this was her first call. What was her message? The vision?
She really hammered home this idea that USR isn't just another company. It's addressing a mission-critical national need.
Right, the supply chain fragility, China dependence.
Exactly. Eliminating that single point of failure. Building a resilient domestic supply chain, that's the mission. And the CFO, Rob Steele, he confirmed it. This cash hoard lets them stop worrying about funding rounds and just accelerate the whole mine-to-magnet strategy now.
This acceleration. Okay, does that have a specific price tag? Are they earmarking this new cash?
They are. The plan is to put about $100 million of that towards enhancing the magnet finishing capabilities and speeding up investment in what they call Line 1B at the Stillwater facility.
So boosting production capacity faster.
That's the goal, pushing that Line 1 capacity up towards 1,200 metric tons quickly.
All right, let's dig into the strategy itself then, this vertical integration idea. 3 main pillars, they said. Let's start downstream, where the product gets made. Stillwater, Oklahoma, Magnets. How's that looking?
Progress seems pretty solid there. They said Line 1A assembly is on track. They're targeting commissioning in Q1 2026.
Q1 26. Okay, so that's coming up relatively soon. That's when they actually start making things.
That's the plan. The transition from just development to actual manufacturing. And they gave some examples of commercial traction, too.
Oh, really? Like the what?
An MOU, Memorandum of Understanding, with a company called Enduro Pipeline for neomagnet deliveries, scheduled for early 2026.
Okay, so lining up customers already.
And also a joint development agreement, a JDA, with ePropelled, for supplying sintered neomagnets. So it shows the demand isn't just theoretical, Customers are actually signing up.
Got it. So cash, dot check, manufacturing plans, dot check, tech. But that Stillwater plant, it needs the right ingredients, right? The specialized metals and alloys,
Right.
which brings us midstream. And this LCM acquisition, less common metals.
Ah, yes, LCM. This could be the absolute linchpin for the whole thing. It's why the market likely reacted so positively.
Why is it so critical?
Because acquiring LCM, and they expect it to close before year-end, just waiting on UK regulatory nods, it instantly gives USR something they couldn't build quickly: expertise. Over 30 years of deep knowledge in making these specialty metals and alloys.
So they're buying the know-how.
Exactly. Know-how that basically doesn't exist at scale anywhere else in the US right now. It's huge.
And capacity-wise, what does LCM bring?
It immediately gives them 1,500 metric tons of NDF strip feed capacity.
NDF.
Neodymium iron boron. It's the alloy strip they press and cook center into the high-performance magnets. And they plan to expand that LCM capacity to 2,000 metric tons in 2026.
So LCM provides the crucial input material for Stillwater. It connects the dots.
It's absolutely critical feed. Without it, Stillwater is just an empty building.
Now, I remember something interesting from the call. LCM makes more than just neodymium stuff, right? There was another mineral.
Yes, absolutely. Samarium. This is really important. The U.S. Geological Survey identified samarium as the mineral at the highest risk of supply chain disruption.
Highest risk. Wow. What's it used for?
Critical defense applications, specialized medical devices, things where you absolutely cannot rely on a shaky supply chain. So by getting LCM, USR isn't just a neodymium play anymore. They're positioning themselves as a supplier of ultra-critical materials.
That definitely adds another layer. And they mentioned Europe, too.
Yeah, leveraging LCM's existing government ties over there. They're planning a strategic, heavy, and light rare earth metal facility in France, bolstering that whole ex-China allied supply chain idea.
Okay, let me just push back a little here. That all sounds great technically, but LCM is in the UK, USR is US-based. Now they're planning something in France. Isn't there a big integration risk? Closing by year-end, merging cultures, managing across borders? Sounds optimistic.
That's definitely the central operational risk everyone is watching, no question. Management acknowledged it's complex, but they stressed the technical teams are already working together, the integration planning is well underway. They basically argued the necessity of LCM's expertise just outweighs that risk.
And the $400 million helps smooth things over, presumably.
You bet. It lets them throw resources at the integration, hire consultants if needed. Failing on the LCM integration just isn't really an option for the strategy to work. The stakes are too high.
Understood. Okay, moving up the chain then. Upstream, the raw materials. Round Top, Texas. What's the latest there?
Round Top is moving into the Pre-Feasibility Study phase, the PFS. They're targeting completion around Q3 2026. That's a key date for investors to track.
Q3 26 for the PFS.
Got it. But there was a really interesting, almost surprising detail from the piloting work they've done on the separation side.
What did they find?
They successfully isolated hafnium.
Hafnium. Wait, that's not typically grouped with rare earths, is it? What's that used in?
You're right, it's different. It's a specialty material. Think advanced semiconductors, control rods and nuclear reactors, high-end aerospace alloys. It's very high-value stuff.
So was that just luck? Or were they looking for it?
It sounds like a successful isolation, demonstrating the chemical flexibility of the Round Top resource itself. It broadens their potential product suite significantly.
Yeah, it moves them beyond just rare earths into specialty materials for completely different tech sectors, high margin sectors.
Exactly. It could really change the whole valuation narrative down the line if they can commercialize it.
And the final piece, upstream the circular economy bit, recycling.
Yes. Important for costs and that domestic security story. They finished bench scale testing for recycling swarf.
Swarf, that's the metal scrap, right? Like shavings.
Precisely. The filings and scrap from grinding and finishing the magnets, they've got a process worked out, and it's moving to pilot scale testing in Q1 2026.
So closing the loop, using their own manufacturing waste.
Right. Reduces need for new raw materials, lowers input costs, strengthens that whole self-sufficiency argument.
Okay, let's zoom back out. Market context. We know there are execution risks. Building all this stuff takes time and skill, but management sounded really bullish on demand. What were they actually hearing from potential customers?
They talked about seeing thousands of tons of growing demand for 2026, 2027, and further out.
Thousands of tons. From where, mainly?
High-growth areas, drones, EVs, obviously, data centers needing power-efficient components, and defense contractors. Lots of inbound interest.
And what was the tone of those inquiries?
According to the CFO, the main question they keep getting is basically, how quickly can you actually produce this stuff?
So suggesting maybe planned capacity isn't even enough?
It strongly suggests that even their accelerated target, that 1,200 metric tons, might not meet the immediate demand coming in for 2026, which is, a good problem to have, potentially.
A very good problem to have. But despite that strong demand signal, they didn't give financial guidance, right? No revenue forecasts.
Correct. No formal revenue or EPS guidance for 2026. They kept the guidance strictly focused on execution milestones.
Like what?
Getting LCM integrated successfully, completing that round-top PFS on time, and hitting the Q1 2026 commissioning date for Stillwater. Those are the near-term hurdles. That's what the street will be watching like a hawk.
Makes sense. Prove you can build it first. Now, risk. We touched on integration risk, but there's always that boilerplate language in filings for companies like this. The substantial doubt about going concern.
Yes, that was in the filing. And we absolutely have to mention it. It's standard mandatory disclosure for pretty much any pre-revenue company.
Just highlights they need funding to get to profitability.
Exactly. But the market's reaction, bidding the shares up, tells you that investors largely dismissed it. Why? Because of the $400 million plus in cash.
Right. That cash runway is the ultimate counter-argument to the going concern language.
It provides years of operational freedom. It pushes any potential need for dilution way down the road. It's the biggest risk mitigation factor they have right now.
Okay. What about actually scaling up production? Did they mention any bottlenecks they're worried about?
Yeah, they acknowledge two main constraints they're actively managing. First is capital equipment. Some of this specialized machinery has long lead times.
How long?
Up to a year for some pieces. So they're already planning and ordering for Line 2 expansion, aiming for 2,400 metric tons capacity in the 2026-2027 timeframe. They have to order well in advance.
Shows confidence, I guess.
But
what's the second constraint? Always the tricky one for high-tech manufacturing.
People. Human capital. Finding and training the specialized workforce. Engineers, metallurgists, technicians who know how to actually make these advanced magnets.
Right. You can buy the machine, but someone needs to run it.
Exactly. And this is where that LCM acquisition is, again, so valuable. They're not just getting equipment and processes, they're getting an existing pool of experienced talent. That drastically cuts down the time needed to ramp up the workforce.
Okay. So the whole story. Stillwater, LCM, samarium, round top, hafnium, recycling it, all fits neatly into this bigger picture, doesn't it? U.S. government pushing reshoring, China export controls, DoD needing secure supply chains.
It plays perfectly into those macro tailwinds. They're positioning themselves not just as a miner, but as critical domestic infrastructure.
Infrastructure protected by policy.
That's the narrative.
Yeah.
And management even said, look, we're prioritizing the defense sector first, even though it's a smaller part of the total magnet market.
Why do that?
Because of the criticality. It underlines their strategic alignment with U.S. national security goals. It sends a strong signal.
Okay. This is Talk Tickers, which means it's time for our This Is Not Financial Advice segment. That outrageous but plausible trade idea based on the call, what have you got?
All right, so the proposition is a pair trade. Long USR equity and short the broader rare earths ETF, REMMX.
Long USR, short REMMX. Okay, why the pair? REMMX is volatile. Sure, it reflects commodity prices, down about 7% last month. Why not just be long USR if you like the story?
Because the pair trade specifically hedges out that general rare earth commodity price risk. USAR's story, I think, is starting to detach from just the day-to-day price of neodymium.
How so?
They're locking in their feedstock with Round Top and LCM. They've got the $400 million cash buffer. They're building domestic manufacturing infrastructure with strong policy support. That's different from most RMS companies, which are often pure exploration plays highly sensitive to commodity swings and geopolitics.
So the thesis is USR gets valued differently now, more like an infrastructure or specialty industrial company based on its future production capacity rather than just a miner.
Precisely. As they hit milestones, LCM integration, Stillwater commissioning in Q1 26, the market should theoretically, value them more on execution and secured capacity. This could let USR decouple from the RMMX basket's volatility and potentially outperform significantly. The trade aims to capture that decoupling.
Interesting. Maximize the USR-specific story, minimize the general sector noise. Okay, wrapping up this deep dive then. Key takeaways. Q3 loss wasn't the story. It was the huge post-warrant cash position, over $400 million.
Right, which enables that accelerated manufacturing plan, the $100 million investment boost.
And the LCM acquisition, which seems absolutely pivotal for solving that midstream piece, bringing in crucial expertise and capacity.
Yep. But now the focus shifts entirely. It's all about execution. That cash buys them time, it buys them runway. They have to deliver.
What should listeners be watching most closely?
Q1 2026 commissioning for Stillwater. That's the first big manufacturing proof point.
Yep.
And the Round Top PFS timeline, Q3 2026. Hitting those operational milestones is everything now for credibility.
All right. And finally, that provocative thought for our listeners to chew on.
Okay, think about this. Management said they're prioritizing defense first. Now, if, and it's an if, but if USR managed to land a major long-term procurement contract directly funded by the government or the DoD, something that guarantees volume for years.
Okay.
How would that immediate guaranteed offtake fundamentally change their cost of capital? How would it completely erase even the perception of that going concern risk we talked about? That's the kind of policy-driven catalyst that could be a game changer.
A guaranteed government customer. Definitely something to think about. Great stuff. Thanks for diving depth with us on USR.
My pleasure.
We look forward to exploring more knowledge with you next time on Talk Tickers.